My presentation today is going to be kind of rehashing a lot of the things that Eric talked about when we do an assessment. We're going to take a little bit deeper dive, and part of it's going to be a math class, so I'm apologizing up front. We're going to dive into profit and loss statements, income statements, etc. So my first question is, how many have up-to-date financials? Way to go. How often do you guys prepare them? Monthly. That's awesome. Oh, well, there you go. Yeah. Well, it's a scorecard, as everybody knows. It's your report card, and it's a great way to track things, looking for anomalies, looking for things that might be costing you money. I can tell you from experience, there's an awful lot of people out there, especially in the construction trades, that don't keep their books. They say, my accountant takes care of that. I don't look. I don't know. And so a lot of people that because of that, they're not making any money and don't even know it. Maybe that's just a denial thing. I don't know. But we're going to cover how to find instant and immediate cash flow as a small business owner, how to uncover hidden revenue using your P&L. And I'm going to simplify this process, helping you to understand the 3 key numbers in your P&L statement. And finally, I'm going to show you how to use those numbers to create exponential growth for your business. And by doing so, hopefully you will dominate your market. So most of you know what this is. This is, if you've gone to any business class, you know what these are. Your balance sheet is your assets, liabilities, and equity. Your income statement measures revenues and expenses or net income over a specific period of time. And the cash flow statement measures net change in cash from operating activities, which involves accounts receivable, accounts payable. How often do you folks look at your account receivables? Yeah, good. Yeah. Have you ever let a client go, if you have a net 30 client, have you ever had one go 90 days or 120 or 6 months? Yeah. Right, I know. Just saying up front that the longer those lay out there, the longer it goes, the less and less chance you have of collecting a penny from those guys. So this is what it looks like. These are the basic fields that you're going to look at. Gross revenue over income is your revenue, or income is your gross revenue. Cost of goods sold, everything that goes into what your product is, whether it be a service or a widget or whatever. Your gross profit, which covers all your overhead, and your gross profit percentage is that number divided by revenue. Then you have your fixed cost, which is your overhead, and your net profit, which is your net income or your bottom line, and the profit percentage is your net profit over revenue. So these are the things we're going to kind of just look at on kind of a case-by-case basis. So there's only 3 areas of this balance sheet that you can impact, and that's revenue, cost of goods sold, and overhead. The rest of those things are just part of the equation. If you guys don't mind, I need to sit down because I hurt my back. So I apologize for that. Here we go. All right. So these are areas that we're going to show you how to make dramatic financial gains with 0 cost, revenue, cost of goods, and overhead. So costs incurred to deliver your contract of sale: labor, materials, scrap, packaging, distribution and shipping, sales commissions, etc. Might also involve the parts that go into a widget, whether it be making a car, all the parts that go into that as part of your cost of goods sold. Any other that you can think of? Like what would you consider cost of goods sold in your business? Yeah. Marketing, right? Because you buy and sell houses. Yeah. And also the fix-up costs in your house? Listing, all that kind of good stuff? No idea? Okay. So, and this is overhead. These are basic. This is the things that just don't go away. Mortgage or rent, insurance, utilities, office supplies, general maintenance, advertising, janitorial. And these are all things that you should shop on a regular basis. So this is an example of what happens to your net profit if we lower cost of goods sold by 5%. It adds another $9,000 to your bottom line. Pretty straightforward. When we lower overhead by 5%, it only increases your bottom line by $3,000. So we always want to be focusing on cost of goods sold when we're looking for ways to save money. So what if we do all three? What if we increase revenue, cost of goods sold, and overhead? It increases our profit by $27,000. That's the compounding effect. So this is the kind of thing that we do when we sit down with a new client. And I'll just kind of give you a little rundown of how we work. We get an opportunity to meet with a client, and the first thing we talk about is their mindset. You know, how coachable are they? How intent are they on actually making these changes? That's a filter that we use. We may not work with them because we consider them to be uncoachable. The second thing is we dive into these financials. We look at every line item, looking for ways that we can save money, okay? And all those things in cost of goods sold and overhead, we're looking for ways to increase sales. Eric talked about that in detail with bundling, cross joint venture relationships, etc. So what do most businesses do when they want to increase their profits? They advertise, right? They think I got to hire an online advertiser and a digital marketing company to help me grow my profits. But that costs money, doesn't it? All the other things that we talked about are almost free. They're just tactics that you can implement. So all those things that Eric talked about earlier and the things that I just reiterated, those are the things that you do first. That's why we have that Jumpstart 12 list that we, as far as our business assessment goes. This is the last thing that we would look at. So we know it costs money, and we know our gross profit percentage is 0.4%, or 40%, excuse me. So that number divided by 40% is $67,000. So we got to basically add that to the revenue, and that changes all the numbers. And you can see that you have to increase your revenue top line number by $67,500 to make that work. So that's why we say it's the last thing that you should consider. Okay, how to build it from scratch, how to discover your business's true financial potential, and how to, I'm going to show you how to understand with close to absolute certainty if Facebook advertising will work for your business. And that's just a little formula that we put together for you. Oh, excuse me, this chair is pretty wobbly. Okay, so just got to gather all the data. Get 12 months. If you don't have your statements up to date, just get all the information. Find out everything you spent money on, everything that came in. Break down your withdrawals into COGS and overhead, and add it to the balance sheet. Pretty simple. Now, we can help you with this. This is something that we will do for somebody if they don't have up-to-date financials. And I will say this, if you don't have up-to-date financials, you're not going to be able to go get that SBA loan when you need it, or basically you're going to want to get that SBA loan for your rainy day fund maybe when you don't need it. That's the best time to get one. But without good books, the bank isn't going to lend to you. The second thing is it's going to affect your sale price when you decide to sell. Who here is planning on selling their business at some point? Anytime? Okay. How long? 5 years? Okay. Well, if you're thinking about doing that, now's the time to be starting to think about all the ways you can get that maximum valuation. Typically, I work with business brokers, and 3 years is kind of the minimum. And it takes that much time to actually get a business positioned properly to get ready to sell for max valuation. So that's another thing that we can help you with. That's a big part of the service that we provide. So how do you know if your numbers are good or just average? Real simple. Examine your gross profit percentage. Look at your profit margin by industry and compare that average with your gross profit percentage. And how do you do it? Just go to Google. Go to Google and put in gross profit percentage for counseling businesses, gross profit percentage for lawyers, gross profit percentage for contractors, or plumbers, whatever it is. And it'll give you an average, and that way you can tell if you're above or below or on track. And if you're below, maybe it's time to start thinking about ways to look at that. Okay, how to increase that profit. So this next thing here is, this is pretty fun. How do we know if Facebook advertising is going to work? Let's take an accountant as an example. We know that their business has a pretty low cost of goods sold, right? Pretty low overhead. Most of those businesses range in the 10 to 20% range of actual costs when doing business. It's not much there. It's completely different if you're a contractor. Your bottom line, or excuse me, your cost of goods sold overhead in the contracting business is going to take your gross profit percentage down to about maybe 30, 40% at the most. And if everything goes right, you might end up with 10 to 15 on the bottom line. That's why it's kind of a tough business. My dad used to have a trucking company, and he said, well, we're going to send a truck out with a load today, and if we don't get a flat tire, we'll make money. So let's look at the lifetime value of a client. Okay, $1,500, say, is the average accountant fee per year. Say he's going to be with you for 6 years. Got 12% overhead, leaving him 88% profit margins, and that's $7,920. So what we do now, I'm going to go ahead and get this all loaded up for you so you can see it. Okay. Say you want to do some Facebook advertising, and your budget's $1,000. And let's say pay-per-click ads are $1.72. That's kind of an average for Facebook. And you're expecting 581 clicks. Okay. Cost of that is, the conversion rate on that might be, say, 9.21 is the average Facebook conversion rate. So the number of prospects or leads you're going to get from that is 54. So if the close rate's 15% on leads, which is probably fairly, in line, you're going to get 15%. You're going to get 2 new clients, and the average profit per client, lifetime value of a client, is $7,920. So you spend $1,000 to get $15,840. That's a pretty good deal. So when you're thinking about doing Facebook advertising, run these numbers for yourself and determine, understand you have to know what the lifetime value of your client is. You're in the financial services business, you said? Yeah. Okay. Yeah. Yeah, well, the lifetime value of a client for you could be astronomical. Really big. I used to be in that business. I started out as a financial advisor and did that for about 30 years, and then decided I wanted to get into coaching after I helped the business scale their company from 2 million to 4 million so they could sell it. And I thought, this is a pretty fun business. I want to be a coach. So Eric and I tagged up. We found each other, and we scheduled a 1-hour meeting at Wildflower, I believe, and I think we sat there for 4 hours. So that's how I got here. So I'm just part of the team to help out with this kind of stuff. So that's if you want this slide deck too, I'm happy to give it to you. I also want to throw in here that this came from 5 45-minute videos in our training portal that we have on our website, and it's a course. It's 5 1-hour videos that you can go watch. It's free to all of you for coming to the presentation today. So if you don't mind us giving you an invitation to that, you can go watch those videos anytime you want. It'll give you a recap of this in a lot more detail. I just pulled a few tidbits out of each of those 5 different video presentations. So ways to lower overhead. Audit your bank statements. This is part of our business audit. Your credit card statements, your business invoices. Internet provider, vendors, supplies, insurance, garbage pickup, barter, etc. All those things, you should be looking at those at least on a basis. For those that do their books monthly, I mean, you may not see much change in there, but on an annual basis, or actually a biannual basis, you might see some anomalies in there that are causing the profits to drop. You might be able to look at that and do some forensic accounting and get that figured out. Here's some other ways. Offer your employees participate in a cost reduction program. give them a little spiff if they're able to cut their costs in their particular areas. Eric mentioned outsourcing. We're a big fan of outsourcing. Don't forget that. Replace non-critical positions with temps. Sometimes you have a job where you just need a few extra hands. There's temp services that can save you a ton of money. Reduce overtime. Refinance your debt to lower your payments. Review your credit card fees. And that's a big one. The credit card fees vary widely in a lot of cases. So that's something that's really worth your time to do. And eliminating subscriptions. Eric mentioned the one guy that had a subscription for several years. It cost him $127 a month. Just take the time to look at these things. What I'm talking about here in this presentation is a little different angle on what Eric presented. And it's just blocking and tackling. It's really simple stuff. This is all stuff that you can do, but you have to keep it in mind when you're running your business. And so if you have the time to work on your business instead of in your business, because you've got a few extra profits to eliminate some of the tasks that you have to manage yourself, then you can start doing these things. And that's part of the reason why we try and find profits for our business customers first, because that's the only way that they're going to find the time to actually make that shift. So we do that Jumpstart 12 program, and we show them how to ways to find extra profits, and then they feel a lot more comfortable jumping into a program. How many of you have a coach of any kind? Personal trainer? You have a business coach? It's Eric, right? No. I just want to make a point that everybody who does anything well and wants to be in the top of their game has a coach. You won't find a professional athlete that doesn't have a coach. Tiger Woods, as an example, has 9 different coaches on different parts of his game. So it's worthwhile, and it costs money, but if you're not willing to invest in yourself, how do you expect to improve? You have to invest in yourself to make things better for your life, whether that be personal development, whether it be business coaching, getting in shape, whatever the case may be. So that's just something I just wanted to stress. Leasing versus owning provides flexibility and cash flow. No down payments, just pay monthly, use it up. There's no huge initial investment. Makes it easy to spread the cost of equipment over their usable life and with predictable monthly installments. Leased equipment often comes with maintenance included. I didn't realize that. Leasing also allows you to conserve credit resources for expenses such as hiring, advertising, repairs, inventory, or market expansion. So it's just keeping the money in the business. That's the rule of thumb. Buy it, but lease it. So it makes me wonder how come more people don't lease their vehicles. In the first 10 minutes, it drops about 20%. Corporate structure, forming an LLC or incorporating a business means turning your sole proprietorship into general partnership. Just run off of an LLC. Everybody, yeah, it's pretty simple. You can set one up so cheap these days. Now, I know that there are some tax savings if you decide to shift to an S Corp. And that depends on your individual situation. And I don't profess to be an accountant. I'm not one. That's something that you need to talk with a professional about to see if it's worth your while to go from a LLC to an S Corp. But in some cases, it could make a tremendous difference in your actual bottom line. Other ideas to lower overhead? Anybody have any? No? Okay. Yeah, just shop, do an audit. Like I said, this is simple blocking and tackling. I'm just reiterating. Correct. There you go. There you go. Yeah. Anybody else? Okay. So the best way to lower your cost of goods sold, negotiate with your suppliers for better pricing. Optimize your inventory. How many of you have a warehouse with stuff sitting in there that's been collecting dust for longer than 6 months to a year? If that's the case, put it on eBay and turn it into money because you're probably never going to use it. Automate your processes such as invoicing and payroll services. Yahoo, right, exactly. It's so much less expensive to hire an outsourced company to do that for you than trying to do it in-house. Especially if you have a bunch of employees. Energy saving measures such as LED lights or turning off equipment, outsourcing non-core functions such as customer support, as I mentioned, accounting and payroll. Reduce waste, that's scrap, depending on what you have. If you're a home builder and you have to buy big lumber packages, you're always trying to save money on those and make sure you have as little scrap as possible. That costs you money. Set payment terms to manage account receivables. Offer discounts. How many of you offer discounts for people that pay on time? Anybody? How many charge interest if people go beyond their term agreement? You have to. I mean, you got to set a standard there and set the bar. If you've got somebody on net 30 and he goes to net 60, he's going to pay some interest on that. It's going to go up. And he might lose his ability to keep his net 30. These are all things to just think about. Manage your account, monitor your account receivables. As I mentioned, make every effort to collect early. Use credit checks before offering payment terms. That's something a lot of people, I don't know, how many, anybody offer terms on their sales? Okay. It's a great idea to do a credit check. Offer discounts or extended payment terms who pay on time. Your good customers. Reward them for that. And let them know they're being rewarded. Tell them about it. Eric mentioned that one of the best ways to increase your revenue is to go back and reactivate or reconnect with your past clients. That's to me, that's one of the best uses of your time. If you've got a client list that hasn't done business with you in a long time and you haven't spoken with them or engaged with them in a long time, pick up the phone and call them. Ask them what's going on. I mean, they might, and if anything else, if they're not ready to do business with you or done doing business with you, ask them for a referral. You can always do that. We talked about this in detail. Increase your pricing. You can always do that. Sell more stuff. Itemize and review your account receivables you're paid. Increase your price. How many in here are afraid to raise their prices for any reason whatsoever? Anybody? Yeah. It's if you're selling, services or really any kind of a product. In most cases, if you raise your prices because you feel like it's justified and you can justify it with the value, go ahead and do it because you'll be surprised how few customers will leave you if you treat them well. And the trade-off of increased profits because you raised your prices versus the customers that you're going to lose is probably going to be a positive number if you do it right. And, we advise our clients on how to do this all the time. These are all the tactics that Eric described earlier. Once again, just reiterating, create and implement a marketing program, joint ventures, upsell, cross-sell, downsell, bundling, et cetera, et cetera. And there's that reactivate old clients again. And review your account receivable. I mentioned that earlier. Don't mess around with that. Collect that money if it's out there. Itemize it. Look at it. See who owes you what and when. Review and prioritize those accounts. Put them in order so you can reach out to them. And find somebody in your organization, or if it's you, do it. Just pick up the phone and call these people. Don't let them lag. Set up a tracking and notification system so you don't get in that place where you've got an account receivable laying out there that you forgot about. That can happen. And collection agencies are the last resort. So this is probably the key part of this whole presentation is why are having up-to-date financial statements important when you're ready to sell your business? Anybody have an idea?
One, if you've got an interested buyer, you can move quickly. If you don't have that stuff together, you've got to get it together before you can give them their due diligence.
Correct. And as I mentioned, 3 years is kind of the amount of time that you're going to need in most cases to position that company for maximum value. If you have financial statements going back at least that far, maybe they're audited, but at least you have a good quality track record of where your money's coming and going and who your customer base is, how the company's growing, is going to give that buyer a lot more interest in buying your company at a higher multiple. Let me go back here. Oops. So we talked about multiples. I don't know if you can read that or not, but minimal accounting systems and unauditable books and records, accounting not to GAAP standards, you get a 2 to 3 times multiple. Limited information systems, non-reviewed or audited, accounting general consistent with GAAP, 2 to 3 person senior staff, you're going to get 3 to 4 times. Adequate information systems, reviewed statements, bookkeeper on staff, controller on staff, management team, growth consistency, all demonstrated through your financial statements. 5X is going to give you, you need state-of-the-art information systems, timely accounting reports, generally reviewed for audited financials, competent and complete management team, growing faster than the industry, another key metric, 15+% EBITDA margins. 6 times. Add all that up, and you've got a much higher multiple if you've got a transition management team in place, meaning that when the guy, whoever buys your business, knows that they have a staff that's going to be left behind that can keep the thing going until that person or that person is able to bring in his own staff, is going to make that company a lot more valuable. So these are all the things that I wanted to just run by you today, and it's pretty straightforward, as I said, so I blasted through it. Any questions? Uh-huh. Yeah. There's money in the bank account. I'm good, right? I can't tell you how many times I've heard that. No, not nearly enough information. I mean, you can show how much money is in the bank account, but how much money is actually going in and out of the company, and our sales, which direction are sales going, which directions are profits going. These are all the things you just have to look at. They're all metrics, and it's all worthwhile to just take a little bit of time every quarter and pull together your balance sheets and your income statements and your cash flow statements. And on the cost of goods sold, just put in there everything that is needed to make that sale. And the overhead is going to be your light bill, your rent, your lease on your truck, gasoline, whatever the case may be. And you can rebuild those things and just start monitoring. That's the only best advice I can give you. So, any other questions? Okay, thank you.